Every time you sign something at a bank, you're agreeing to rules written by people who profit when you misunderstand them. Marcus walks into the bank holding a single piece of paper, a loan agreement he doesn't fully understand but needs to sign to buy his first car. The loan officer, a cheerful woman with a perfectly pressed suit, slides the contract across the desk and points to a dotted line with a pen that seems to glow. Marcus skims the first page, sees numbers he recognizes, monthly payment, interest rate, total amount, and flips to the end. He doesn't read page 7, where a clause explains that missing a single payment triggers a penalty fee, a higher interest rate, and a mark on his credit report. He signs. This is an example of information asymmetry, a situation where one party in a transaction knows significantly more than the other. The bank designed this contract, knows every clause, and has seen thousands of people sign without reading. Marcus, on the other hand, is making one of the largest financial commitments of his life based on a 15-minute conversation. What's happening here is a power imbalance embedded in the structure of consumer banking itself. If you found this video useful, please consider subscribing, liking, sharing, and leaving a comment. It helps the channel grow and allows us to continue producing documentary-style content like this. Banks don't just lend money. They engineer the terms under which that money changes hands. In the 1970s, deregulation allowed banks to set their own interest rates, moving away from government-imposed caps that had existed for decades. This shift gave banks the freedom to price risk individually, but it also gave them the power to charge more to people who had fewer options. Economists describe this as price discrimination, a practice where the same product is sold at different prices to different people based on their circumstances. A person with a high credit score might get a car loan at 4% interest, while someone with a lower score pays 12% for the exact same car. The bank argues this reflects risk, the likelihood that the second borrower might default. But the system that determines credit scores, the one that decides who is risky, is itself controlled by private companies that profit from the data they collect. This pattern appears when financial institutions gain the ability to both create the rules and profit from them. The result is a self-reinforcing cycle. People with less money pay more to borrow, which makes it harder for them to build wealth, which keeps their credit scores low. Meanwhile, banks don't just earn from interest, they also collect fees. Overdraft fees, for example, generated $33 billion in revenue for U.S. banks in 2019 alone. These fees are most often charged to people living paycheck to paycheck, the same group least able to absorb the costs. What's happening here is regressive pricing, a system where those with the least resources pay the highest costs. It's the opposite of a progressive tax, where higher earners pay a larger percentage. In banking, the structure itself extracts more from those who can least afford it. Marcus misses his payment in month 4 because his car broke down and he had to pay for repairs. He doesn't call the bank. He assumes he'll just pay double next month and catch up. But the late fee arrives in his mailbox 3 days later, $35. Then his interest rate increases from 7% to 12%, a clause buried in the original contract he signed. His credit score drops 20 points, making it harder for him to refinance or negotiate better terms. This moment reveals how the system works, not through transparency, but through triggered penalties that compound. Behavioral economists call this a poverty trap, a situation where a single financial mistake triggers a cascade of costs that make recovery nearly impossible. Marcus now owes more than he originally borrowed, and the bank's profit margin has increased. He considers switching banks, but every institution he researches has similar terms. This is oligopoly in action, when a small number of firms dominate a market and behave in strikingly similar ways. In theory, competition should drive better deals for consumers, But in practice, banks have little incentive to undercut each other when they all benefit from the status quo.
The average American has limited time to research financial products, and most contracts are written at a college reading level, despite half the population reading below that.
What appears to be choice is often just the appearance of choice, a menu of similarly unfavorable options. Marcus eventually refinances through a different lender, but the new contract has its own buried clauses. He's not trapped by a single bank. He's trapped by the design of the system itself. The language banks use, terms like pre-approved, special offer, or exclusive rate, creates the feeling of being chosen, even when the terms are standard. This is an example of framing, a psychological tactic where the way information is presented shapes how people perceive it. This is an example of framing, a psychological tactic where the way information is presented shapes how people perceive it. But by then, many people have accumulated a balance they can't pay off in full, and the bank begins collecting interest. Banks profit not from people who pay on time, but from those who carry balances, customers the industry calls revolvers. This pattern reveals a counterintuitive truth. The ideal customer, from the bank's perspective, is someone who borrows but never fully repays. This pattern reveals a counterintuitive truth. The ideal customer, from the bank's perspective, is someone who borrows but never fully repays. Regulatory agencies have attempted to address these practices, mandating clearer disclosures, capping certain fees, but enforcement is inconsistent. Lobbying expenditures by the financial industry regularly exceed $500 million annually, influencing the rules that govern how banks operate. What's happening here is regulatory capture, a phenomenon where industries shape the regulations meant to control them. Marcus eventually pays off his car loan after 5 years, having paid nearly double the original price when interest and fees are included. He's more careful now. He reads contracts, avoids overdrafts, keeps his credit score high. But his experience isn't a failure of personal responsibility. It's a demonstration of how systems distribute power. The bank didn't lie, didn't break the law, and didn't force him to sign anything. It simply designed a system where understanding the full implications required expertise most people don't have. This moment reveals the quiet power of complexity. When institutions benefit from confusion, clarity becomes a competitive disadvantage. Every signature you give moves resources from your hands into theirs, not through force, but through agreements you were never truly equipped to evaluate. The puppeteer doesn't need to be cruel. They just need you to keep pulling the strings you think you control.